Hi, Assalamualaikum warahmatullahi wabarakatuh, and a very good evening. To complete our syllabus on the topic of interim and segmental reporting, we need to prepare a presentation of the interim and segmental reporting for the company we have chosen. Our group have chosen an illustrative corporation limited for these presentations. On these presentations, we will present on the two parts, which is the part A is interim reporting and the part B is segmental reporting. On the part A, we will go through on the basis of preparation interim reporting. The next is two accounting policies. The third is the type of interim reports. Number 4, the period of the current and the comparative of each statement. And the last is two proposed adjustments made by the company. And the next is the part B. The part B we will go through on the company background. The next is management approach. The third is the factor for having a segmental report. Number 4, the type of segmental report. Number 5 is identify CODM and their responsibilities. And the next is reproducing of the segmental report, a new segmental report, and the conclusions. And the last is advantages and disadvantages of segmental report. Okay, before we go further for the next presentations, let me introduce our group team members. Our group team members, they are HURUL AINI BINTI RAZALI, and the next is Alwani BINTI JOHARI. The third is SALEHUDDIN dan LOKMAN. The fourth is AISHAH BINTI MAHMOOD, and the last is NURSYAFIQAH BINTI SHAIROL HAMIRI. Interim reporting FAR570 is financial report covering period less than 1 year. Have two bases of preparation of interim reporting. They are integral method and another one is discrete method. Integral method is the interim report is fraction of annual report, where is annual value times fraction of the reporting period. And the discrete method is interim report is a separate period, which is the report are prepared on periodic basis. So for illustrative corporation limited, they have choose 6 months ended 30 June 2020 and are presented in currency units, which is the functional currency of the parent company. They have been prepared in accordance with IAS 34 interim financial reporting. They do not include all of the information required in annual financial statements in accordance with IFRS and should be read in conjunction with the consolidated financial statement for the year ended 31st December 2019. So the interim financial reporting of Electronic Corporation Limited has been approved for issue by the Board of Directors of 14 August 2020.
Accounting policy are the specific principle, basis, convention, rule and practices applied by an entity in preparing and presenting financial statement. It has two accounting policies practiced by Grant Thornton. First accounting policy is leases under MFRS 16. Leasing is an important financial solution used by many organizations. It enables companies to finance property, plant, and equipment without the need to incur large initial cash outflow. MFRS 16 leases is intended to provide greater transparency by eliminating off-balance sheet leasing transactions. MFRS 16 requires that a lessee applies a right of use asset accounting approach that will recognize an asset on the lessee's balance sheet, representing its right to use the leased asset over the lease term and recognize a corresponding liability to make lease payment. Second accounting policy is fair value measurement under MFRS 13. MFRS 13 defines fair value set out in a single MFRS standard, a framework for measuring fair value, and requires disclosure about fair value measurement. MFRS 13 does not determine when an asset, a liability, or an entity owns equity instrument is measured at fair value. Rather, the measurement and disclosure requirement of MFRS 13 apply when another MFRS standard requires or permits an item to be measured at fair value. The focus of this post-implementation review is on assessing the effect of MFRS 13 and not assessing the effect of any other IFRS standard that require or permit fair value measurement.
It has 5 types of interim report prepared by Illustrative Corporation Limited. First, condensed consolidated statement of financial position as at 30th June 2020. Number 2, condensed consolidated statement of profit or loss for the period ended 30th June 2020. Number 3, condensed consolidated statement of other comprehensive income for the period ended 30th June 2020. Number 4, condensed consolidated statement of changes in equity for the period ended 30th June 2020. And number 5 is condensed consolidated statement of cash flows for the period ended 30th June 2020.
For statement of financial position, the current period is 1st January 2020 to 30 June 2020, and the comparative period is 1st January 2019 to 30 June 2019. For statement of profit or loss, the current period is 1st January 2020 to 30th June 2020, and the comparative period is 1st January 2019 to 30th June 2019. For statement of other comprehensive income, the current period is 1st January 2020 to 30th June 2020, and the comparative period is 1st January 2019 to 30th June 2019. For statement of changes in equity, the current period is from 1st January 2020 to 30 June 2020. But for the comparative period is from 1st January 2019 to 30 June 2019. For statement of cash flow, the current period is 1st January 2020 to 30 June 2020, and the comparative period is 1st January 2019 to 30 June 2019.
Okay, let's continue to purpose adjustments. Number 1 is the opening inventory was overstated by 32,400 euro, and net realizable value of the closing inventory was 30,900 euro. So for the first solution is cost of inventory is always lesser than the net realizable value in RV to make profit. But following a concept of conservatism, even if NRV is higher than cost, value of inventory is kept at cost and gain is not recognized until the inventory actually sells. However, if NRV is inventory fall lesser the cost of inventory, entity must write down the value of inventory to the amount that can be realized. So NRV is 30,900 euro lesser than cost 32,400 euro. Thus, the value of inventory as at 30 June 2020 is 30,900. Number 2 is, during the current year end, trade and other receivable amounted to 28,407 euro. As at 30 June 2020, the company estimated that only 10% uncollectible by year end. And the second solution is, since there is an estimation of 10% uncollectible by year end, entity must calculate 90% from gross of account receivable as collected portions. Gross amount account receivable times collectible rate of 90%, which is at 28,407 times 90%, will get 25,566.30 euro. So the net amount to be reported is 25,566.30 euro. So this is a extract of statement of financial positions before and after adjustment as at 30 June 2020. So for inventory, the first is 32,400 before adjustments and became 30,900 euro after adjustments. And trade and other receivable before adjustment is 28,407 and became to 25,560.3 euro after adjustment.
Assalamualaikum and a very good morning. I'm NURSYAFIQAH binti SHAIROL HAMIRI. Today I will explain about the company background. So the company that we choose is Illustrative Corporation Limited. Illustrative Corporation Limited is the group ultimate parent company. It is a limited liability company incorporated and domiciled in HURUL. The address of its registered office and the principal place of business is 140A Great Place, 40,237 Grateful HURUL. Illustrative Corporation shares are listed on the Great Stock Exchange. We talk about the nature of operation. The principal activities of Illustrative Corporation and subsidiaries include consulting on, servicing and sale of customers' IT and telecommunication system. These activities are grouped into the following service line. First is consulting, which is focused on the design and sale of the phone and intranet-based in-house application, customization and integration of IT and telecommunication system. Second is service, which is provide after-sale service and maintenance of IT and telecommunication system. Third is retail, which is involved in the online sale of hardware and software product of the group business partner. We proceed to the management approach, a component of an entity that engage in business activities from which it may earn revenue and incur expenses, whose operating results are reviewed by the CODM to make decisions about resource allocation and performance assessment for which discrete financial information is available.
Factors to consider having segments. MFRS 8. An operating segment is a component of an entity that engages in business activities from which it may earn revenue and incur expenses, including revenues and expenses relating to transactions with other components of the same entity. There is two types. First is business segment analysis, which is primary reporting format, and second is geographical segment analysis, which is secondary reporting format. Under MFRS 8 also, an operating segment is a component of an entity whose operating results are regularly reviewed by the entity chief operating decision maker to make decisions about resources to be allocated to the segment and assess its performance. operating segment. Then it go to products and services, and it go to segment manager. Next is HQ management, and it divided into two: allocate resources and assess performance. Next factors to consider having segments reporting under MFRS 8, an operating segment is a component of an entity for which discrete financial information is available. A reportable segment meets any one of quantitative 10% threshold. Reported revenue is 10% or more of the combined revenue of all operating segments. Reported profit or loss is 10% or more than the combined reported profit or loss of all segment reporting. The segment assets are 10% or more of the total asset of all operating segments. If reportable segment did not meet 10% threshold, ensure that the total external revenues attributable to those reportable segments is at least 75% of the group's total external revenue. When 75% threshold is not met, additional reportable segments should be identified even if they did not meet the 10% threshold until at least 75% of the group's total external revenue is included in its reportable segment. For type of segment, there is two types. First is operating segments. Is a component of a public entity that engage in business activities for which discrete financial information is both available and regularly reviewed by the chief of decision maker. The characteristic: it engage in business activities from which it may earn revenues and incur expenses, and its operating results are regularly reviewed by the public entity's chief of decision maker to make decision about resources. Third is its discrete financial information is available. Second one is reportable segment. For public entity must identify which operating segment are reportable segment that should be disclosed. Characteristic: result from aggregating two or more of those segments in accordance with the following paragraph, and it exceeds the quantitative threshold, and aggregating similar segment. For chief of operating decision making, chief of decision making will vary from entity to entity. For individual, it will be group of. For individual, it might be CEO or COO, and for group of people, it might be senior management team or board of directors.
Assalamualaikum warahmatullahi wabarakatuh. I am Alwani binti JOHARI as a last presenter who will present our new segmental report referring to choose financial reporting. As a new account executive of the Illustrative Cooperation Limited, we are required to reproduce a new segmental report. The group has three operating segments, which is consulting, service, and retail. In identifying this operating segment, management generally follow the group service lines representing its main product and services. These operating segments are monitored by the Group Chief Operating Decision Maker, and strategic decisions (CODM) are made based on adjusted segment reporting results. Firstly, we need to identify at least 4 reportable segments and 1 non-reportable segment from the operating segment. To figure out the reportable segment, we need to run a 10% threshold test on the operating segment. We choose to use segment assets which consist of external revenue and inter-segment revenue resulting the total revenue. We need to find the total revenue for each of operating segments. For example, electronic segment, the external revenue amounting to 15,000 need to be added with the inter-segment revenue amounting to 3,000, resulting in total revenue 89,000. amounting to 148,142 ringgit and multiply it all by 100%. So, the percentage got from electronic segment is 12.2% more than 10%, which can be classified as reportable segment, while operating segment, which got a below than 10%, should be classified as non-reportable segments. All the processes above are to determine that the percentage caught from the test must be at least 10% or more than all segments combined revenue. If a segment satisfies the 10% test, it should be classified as separately reportable operating segment. This means that you will have to provide disaggregate financial information specific to that segment operations. The process continues repeatedly for all operating segments. After running a 10% threshold test, we can conclude that electronic, consulting, service, and retail segments are reportable operating segments, while software and sales of used IT equipment are non-reportable operating segments. According to MAHFARS 8 requirement, the combined revenue earned by sales to external revenue in separately reportable operating segments must be at least 75% of total consolidated revenue across all operating segments. If this 75% threshold is not met, you must disclose financial information on additional operating segments, even though they do not satisfy all of the criteria explained above, until the 75% bar is met or exceeded. To reconfirm the statement above, we should run a test of 75% threshold test. Firstly, we need to sum up the external revenue of total operating segments that amounting to 129,227 ringgit, divide it by the total external revenue of all operating segments amounting to 143,296 ringgit, then multiply it by 100% to get the percentage. The percentage got from the test is 90.18%, which is more than 75%. So, we can conclude that the reportable segment meets the 75% revenue criteria. This is also indicates that no need to add any additional operating segment to satisfy the criteria. So, last but not least, this is our new segmental reporting that has been reproduced referring to the analysis that has been made. We are aware that the software in the operating segment is non-reportable. So, we need to disclose it together with the sales of used IT equipment as others in one column.
Lastly, we talk about the advantage of segment reporting. First is transparency and better insight. Better evaluate the sustainable and growth of a company and monitor performance of the management. Second is better predictor of the profitability. Enable users of financial statement to be better able to predict the future profitability of an organization, particularly where segments are involved in diverse activities. Third is lowest cost of the capital. Theoretically, the risk for investment in equity of a company that discloses complete information is lower than that of investment in equity of a company that withholds information. We talk about the disadvantages of the segment reporting. First is emphasis on the present. For the first disadvantage, which is emphasis on the present short-term number, might be over-emphasis in segment reporting. For example, if Illustrative Corporation Limited might have a huge losses and the company overall profitability may not be reflected in the financial account. On the other hand, breaking out such as figure as a data point to reporting get good pressure on the firm to lower those losses in order to boost short-term profitability. Second is data manipulation. For the second disadvantage is segment reporting lend itself to to data manipulation if the information is reported in the true management eye style. The manager may combine together business with a different business model. For example, the manager will manipulate and change the firm data in order to attract the shareholder or investor to invest in their firm.